I think it's time we got a quick little lesson on venture capital. Georges Doriot, a Harvard Business School professor, founded American Research and Development Corporation in the 1940s. ARDC's investment in Digital Equipment Corporation yielded a return of over 500 times its initial investment. And it was this success that drew attention and got others into the game. Who would have thought? It was during this period that the iconic VC firms like Sequoia Capital and Kleiner Park Schofield and Byers were created. Their investments into companies such as Apple and Genentech created massive returns while developing technologies that were clearly changing the world. It also showcased how the VC model could drive considerable economic growth and transform markets. So in other words, that's when VCs started getting popular. But you know what? They actually got a bit too popular. The late 1990s and early 2000s witnessed the dot-com bubble, a period of speculative investment in internet-based companies. And it was during this time that companies like Yahoo, AOL, and Amazon began to really emerge. For example, after going public in 1996, Yahoo's stock price more than doubled just on the first day, and Amazon went public in 1997 and saw its stock price by more than 31% in its first day of trading. It was really, really exciting times, and Alan Greenspan, the chairman of the Federal Reserve at the time, coined the term irrational exuberance. But that was right before things started to fall apart in 2000, because before everything bad comes a little bit of good. The bubbles burst in 2000, resulting in a very significant financial loss for many VC firms and startups, and that prompted a really serious reassessment and reevaluation of the VC approach. And for a while, capital almost completely dried up. The model really needed to get better at things like risk management, due diligence, and also evaluating sustainable business models. And so, as it should, it did. By the early 2000s, VCs had now expanded to the United States, to Europe, Asia, and beyond. Particularly large markets like the BRICS, which is Brazil, Russia, India, and China, they had also started to create more and more successful startups, and even some unicorns. For example, Alibaba. It emerged in China, and in 2000, the VC firm SoftBank invested $20 million into it. That was an investment that would actually earn SoftBank a really big gain of $72 billion. You heard that right, billion, in the years to come. So it was stories like this that really resulted in the explosion of VC firms of varying sizes and focuses around the world, which takes us to where we are today. We have top 10 VC funds in the world today. There's been an absolute explosion of capital in the past decade or so. In part because the LPs, therefore the ones that put the money into the VC, they've seen their profits potential and have thus put massive amounts of capital into it. Who wouldn't want to make more money by putting money? For example, Andreessen Horowitz now has approximately $28 billion in assets under management. And this obviously gives them the ability to make some very, very big bets. But it's not just these large firms that are doing well. That's the best part. There's also many smaller VC firms with anywhere from 10 million or so under management that are also carving out their part of the pipe and making a really tidy profit whilst doing so. Venture funds smaller than $350 million are 50% more likely to generate a 2.5 times return than funds that are larger than $50 million. You wouldn't have thought so, right? Why is that? So there's a number of reasons for this. But part of the reason is that they have more flexibility as to how many potential companies they can invest in. When you have a really massive amount of capital to deploy, it just doesn't make sense for you to do small deals, right? So even if these small deals grew a lot, it would still often not make much of a difference to your overall fund if you're managing billions of dollars. So this actually means that the options for smaller VC firms that are managing around $350 million or less are way more, because there are a lot more companies that are looking just to raise maybe $5 million and anything between $5 and $20 million. And then there are firms that are looking to raise $100 million. So also these bets, if successful, can multiply in valuation at higher levels than larger bets, because market sizes are limited and so big companies only have so far that they can grow in their market, which makes sense as well. If we look at the stats, you can actually see that 8 of the top 10 performing venture capital funds have fund sizes of $100 million or less. And most of these are sector-specific VCs that really deeply understand the domains of the companies that they invest in. You obviously really want to understand that field before you put money into it. Plus, as they're small, they're usually quicker to support their companies that are gaining traction, so they can help them do better and better. As Richard Armstrong reports, he finds it a very interesting time in the venture capital world now, because there's a ton of capital available, but for the last couple of years, since 2021, the funding has been on a very steep decline. Many VC firms got burned after the peak in 2021, and so are far more tentative about doing deals, naturally. There's also a lot more pressure on investing in companies that have a clear path to profitability, which also obviously limits the playing field of who you can invest in. And then, to top it off, more startups are trying to avoid the VC path by either reducing their capital requirements or finding alternative funding mechanisms. In part of other startups, they've had bad experiences with their VC partners, and so therefore they're staying clear of that path. Richie, however, does think that this is temporary and that venture capital will continue to play a really massive role in tech innovation, particularly here in Southeast Asia, since we're at a much lower level of maturity than the US and there's still a ton of growth left. This was a guest post by Richard Armstrong, who is a very early stage investor in many startups in both Southeast Asia and globally. Richard has also co-founded several companies. Thanks for watching. If you enjoyed this, please make sure to subscribe to our YouTube channel and also give us a follow on our TikTok account.